Sector that Spring is choosing in the equity market and the preferred bond tenor in this situation, a rebalancing portfolio strategy that has been or will be undertaken by Spring.
Yeah. Let me start with the bonds first, since we prefer bonds in terms of asset allocation. So bond tenors for our active strategy, there is a tactical strategy that you know the strategy adopts to move between shorter tenor and longer tenor. But we have gone through a sell-off, and whilst volatility may stay still a bit elevated to the end of the year, it may be possible to say that the highest volatility is maybe a little bit behind us. So what that really means is you want to move from shorter tenor back to longer tenor, and think about interest rates either being more stable, or if you think 12 months or 24 months out, following what the Fed has been showing in the dot plot, there's a chance for interest rates to come down. So the direction then for bonds is to think about lengthening duration again after the volatility. And then if we move on to equities, I mentioned earlier that we're thinking about equities defensively and companies that fulfill certain quality criteria. If we translate that into sectors, the most reliable sector in Indonesia has been banks. ROEs are high. The banks are paying very decent cash flows out of their profits. So it's translating into dividends. So a very easy sector continues to be banks, but we would emphasize being selective with the banks, right? And selective with the larger banks where ROEs are higher and less susceptible to being pressured by higher interest rates, because the banking sector is seeing the rising cost of funds. So one sector is banks. Other sectors that we can think of would be between global and domestic. We think that the global environment has been very volatile. Yeah, and commodity prices, we've already seen commodity prices come down. The external environment is less conducive. Going into next year, there's a good chance of global economy being weak and commodity prices remaining under pressure. So between export-oriented commodities or domestic sectors, that leaves us more with the domestic sectors. And what you can choose from that are of lower cyclicality would be sectors like telecommunications and maybe consumer, both of which have done reasonably well in the past 12 or 24 months. In the telco sector, it is a little bit about consolidation and reducing competition. In the consumer sector, essentially it is the more consistent growth that you can get, or even if growth slows down, these companies are unlikely to see a big drop-off in their sales. So there's a higher predictability when looking at companies like this.
Okay, Spring's perspective on the potential of the commodity sectors, given the recent rise in energy commodity prices and ongoing geopolitical tensions in various regions. Even the World Bank estimates that if the Hamas-Israel conflict continues, oil prices could reach like $150 per barrel. Is there an increase in BRI investment management allocation to the commodity sectors? What do you think?
Okay, in commodities, oil specifically is maybe just a small investable segment of Indonesian commodities. And oil prices related to the conflict in the Middle East, we've seen that drive up oil prices for a bit, and then now it's come back down to maybe about $80 per barrel. That geopolitical premium, I think a lot of the historical analysis shows that a lot of the time it tends to go away, right? That it's not really persistent. And that's also what we've seen in the past couple of weeks, that the premium has initially gone up, And then even though the conflict continues, but the escalations have not led to an interruption of oil supply, and it's not really interrupting the oil market. So oil prices have come off. So to think about the portfolio, number one, the sector is not too big, and number two, oil prices have not continued to go higher. So there's very little reason to think too much about oil. Other sectors that are commodity related that we can invest in, I think broadly commodity prices have come down. So as we think about next year, the company's profitability and cash flows may be more challenged next year than this year. And given our strategy of preferring companies that have stable cash flows, that also leads us to generally stay further away from such commodity companies.
Okay, but according to Spring, can the momentum leading up to the elections also influence the attractiveness of Indonesia's financial assets?
I think certainly during the run-up to elections, there may be periods of excitement, but we've gone through a few key events, announcement of the candidates, announcement of the Chawa press. The market hasn't really reacted too much to it. So I suppose the next key date to wait for would be election date in February. So I think these moves could be just shorter term moves in the market. And the other factor that is often related or linked to politics is the spending that happens around the campaigning time. We also think that this spending, whilst it's a good boost to the economy, will only persist for a couple of months and may not be really good enough or strong enough to lift growth materially for the whole year. So what that means is that it's good for sentiment sporadically for certain months. And then I think very quickly the market will move on to thinking about other things. So there's a small positive, I think you can expect, but may not be big enough to drive a big rally.
Okay, so do you find Indonesia financial market for now is still attractive?
So the sell-off that has happened in October certainly resets some of the large cap prices cheaper, right? And with the higher dividend yields that we expect in the next to be paid in the next 6 to 9 months, gives sort of a window for investors who are prepared to collect stocks like this, to be able to collect some quality large caps. And the next payoff is the dividend window in the next 6 to 12 months, 6 to 9 months. And what I could add to that is even in picking stocks like this at this point, we want to think about the sustainability and the growth beyond just 2024, right? And that's why I've also emphasized quality companies with high ROEs, where their growth can be sustained beyond just the next 6 or 12 months, right? You're buying the stocks for the dividends, but you also want to be able to hold on to these stocks for longer than that, right? This recent sell-off maybe presents a bit of an opportunity to collect a few stocks.
Okay, talking about the bonds, expectation for the yield trend of Indonesian government 10-year bonds and the direction of the Indonesia Stock Exchange for the remainder of the 2023 with the fluctuating rupiah. Is there a vision of the IHG for 2023 outlook?
So let's start with bonds first. So bonds will again depend on what the Fed is doing, right? And the 10-year US Treasury. If we measure it to the end of October, yields have come down, markets have bounced. And the Fed, probably 90% probability will hold. So that sentiment in the US may remain somewhat buoyant, allowing bonds to hold on to current levels. I think it would be a little bit premature to expect bond yields to come down materially, both in the US and in Indonesia, especially with a short window until December. So bond yields have been volatile. It was above 7% just a few days ago, and then now it's closer to 6.8. So I think holding these levels, maybe slightly better than these levels, to the end of the year is certainly possible. But it may also mean that for the full quarter, fourth quarter, bonds may be only marginally positive. For equities, we started the quarter closer to 7,000. And in the current bounce, I think there is a good chance that the JCI could get back close to 7,000. But again, we're closing the underperformance that happened in October. But I don't know whether, and I don't think the market will really close at a new high by the end of the year. We're overall still cautious going into the end of the year.
Okay, but how about the opportunities for the window dressing at the end of this year?
So window dressing, maybe we can quote two statistics here. December is usually a positive month, right, in Indonesia. So you could say that December, the whole of December is a window dressing month. So that's a positive sort of statistic. The other is that we've already had a big sell-off in October, and the markets are bouncing now in November. And if you connect that into December, which is positive, then there's good reason to think that the window dress, after having seen the recent market bottom, is happening during November. Whether it can persist all the way to the end of December, there's still a lot of factors at play, specifically still the Fed, right? But I also mentioned that if the Fed is 90% probability of staying where they are, then that would be supportive of markets generally coming back to a bit more risk on to the end of the year.
Okay, so what is your company's target for the next year?
For next year,
yeah,
for bonds and equities. Yeah. So we continue to think that both asset classes will have positive returns into 2024. But bonds obviously is a more reliable source of returns. With yields closer to 7%, 6.8, even if interest rates, policy rates don't go anywhere, you can be more assured of getting that return. That's 6.8 to 7%. So that's a good way of thinking about total return for bonds. It's a little bit premature to think about yields coming down, but certainly if we follow the Fed's existing dot plot, they do think that by the end of 2024, they could start cutting rates very marginally, maybe 50 basis points. So there is the additional boost, you could say, if yields were to come down, that will increase your total return for bonds beyond just the 7%. For equities, what I've said is that the dividend season is in the first half of 2024. And I think going by what we've experienced in 2023, the first half, including dividends, returns should be pretty decent and dividends alone could be close to 4-5%. So I think that's a good starting point. But the whole year will also be challenged by, and for me, I say challenged, the election calendar could be a challenge from my perspective, but at the same time, the market could react positively. So for the equity market, I think you could be thinking about dividends from 4 to 5%, and then on top of that,